The second largest bank failure in American history happened last week. And I've asked Ron Insana, the pioneering financial journalist and co-founder and CEO of Contract Capital Partners, to talk about Silicon Valley Bank's demise. Thanks for making time, Ron.
Thank you, Tony. It's good to be here, as always.
The tech sector is rattled. Hedge fund manager Bill Ackman warned of an economic meltdown over the weekend. Signature Bank in New York failed. Should the general public be concerned?
Should the general public be concerned about the state and fate of the U.S. banking system? I don't believe so. The federal government has taken extraordinary steps over the weekend, as we've seen in other periods of panic and crisis, and has insured all the deposits effectively in the U.S. banking system. So if there is indeed another bank that might be in trouble, deposits are no longer at risk, even if an individual or a company has more than 250,000, which was formerly the FDIC insurance limit at a particular bank. So the Fed, the Treasury, the Federal Reserve, the Federal Deposit Insurance Corporation all got together over the weekend as Silicon Valley Bank failed and as Signature Bank in New York was put into receivership and effectively shut down. Depositors will be made whole. Investors will not be. This is not like 2008 in the sense that there's any bailout of investors in banks if they own the common stock, if they in fact own bonds of any particular bank that might be in trouble. They will not get bailed out. This is a rapid bank run that occurred at Silicon Valley Bank, like in It's a Wonderful Life, with people lining up in front of the bank to get their money out. In this instance, they were making these transfers and these withdrawals via phone, via computer, and it happened in a nanosecond. It was a very, very fast run. To an extent, there are worries that this endangers the broader financial system like 2008. That might be a concern that is a bridge too far here, as the federal government has taken steps to contain the contagion, if you will, and ring fence these banks, both Silicon Valley and Signature, so that they don't infect the rest of the system. Now, there are other regional banks out there that people have concerns about. The Fed, though, again, is making depositors whole at any bank. So the general public, certainly at this point in time, does not need to worry. And as far as deposits go, governments do not let depositors lose their money. It's just not the way governments operate. Investors may, depositors won't.
So, Ron, the bigger question for me is, how could it happen in the first place? You know, I thought after the subprime mortgage mess, there were tests for liquidity that were in place and all of that. Did we not learn from the last mess?
So it is most certain that big banks learned some lessons in the 2008 great financial crisis. Banks are better capitalized today. The Federal Reserve tests them every year to make sure that they are meeting those capital requirements, that they can suffer through a recession and not necessarily have the types of strains or stresses that we saw over a decade ago. The problem with Silicon Valley Bank, which was the 16th largest in the United States, is that they didn't learn lessons from the savings and loan crisis of many decades ago, back in the 1980s and early 90s, where they took in an extraordinary amount of deposits and had a lot of exposure to one industry, technology in particular, fintech and other types of new startup companies. Those excess deposits that they have had on their books, which are liabilities of a bank, they then invested in long-term treasury and mortgage bonds. The problem there is, as interest rates went up rapidly when the Fed was hiking rates, the value of those bonds effectively collapsed. And so they borrowed short, they lent long, they were losing money on that portfolio, and that strained their system. And then some individuals in the tech community told their portfolio companies who had money at Silicon Valley Bank to start withdrawing their funds. They had a classic run on deposits, which effectively threw them into the arms of the government. And we saw something similar taking place at Signature Bank in New York, which had exposure to the crypto industry. So the lessons at the big banks were certainly learned. They are stress tested. They have adequate amounts of capital. They are solvent. There are smaller regional banks that have big concentrations of exposures to specific industries and have a lot of fast-moving deposits in and out that cause their, if you will, their balance sheets to be mismatched. Their liabilities and their assets did not line up. And so technically they became insolvent, and that's what's caused this mini crisis, if you will, that's going on among some of these smaller though important banks in the United States.
Some people are calling this the first ever social media run on a bank. Ron, I mean, in the social media world, it all happens so much faster than it used to, for sure. Biden said over the weekend that as much as they're going to step in to protect depositors, they are going to hold people accountable. What do you think is going to happen this time compared to last time?
Well, a couple different things here. Yes, in terms of social media, because you can withdraw your funds with the touch of a button, this was not It's a Wonderful Life, where people were queuing up at the savings and loan and Bailey Savings and Loan and demanding to get their money. They were demanding to get their money with the push of a button. So it accelerated the pace at which Silicon Valley teetered on the brink of insolvency and ultimately was taken over by the federal government. Now, with respect to what President Biden said, that people will be held accountable, it is interesting that the CEO of Silicon Valley Bank was also on the board of the San Francisco Federal Reserve and probably should have understood that as interest rates were going up, investing in long-term bonds was a very bad idea because the principal value of those bonds decline when rates go up. So that was a very bad bet with respect to where to put your money and match your deposits with your assets, which would be where you put those dollars for presumably for safekeeping. Now, investors will not be made whole in any of this. Investors will not be bailed out in the losses that they suffered owning Silicon Valley Bank shares, if you will, or Signature Bank shares. If they're bond holders of the banks, they're not getting bailed out either. There was some of that in 2008 where some individuals were bailed out that were investors or had other interests in these entities. That's not going to happen this time. The only people who are going to be protected will be depositors and not investors. The companies who are depositors are also being protected because many of these Silicon Valley startups that had invested, I shouldn't say invested, who had put their money on deposit at Silicon Valley Bank need to make payroll. So they have today access to all their deposits, no matter how large they were. If they were larger than the $250,000 that's insured by the FDIC, they have access to that money this morning so they can make payroll, pay bills, and remain ongoing concerns, which would have been threatened if those deposit insurance limits were kept in place. So the Federal Reserve will make all depositors whole, irrespective of size of the deposit, whether it's above what used to be the $250,000 limit, which has now effectively been wiped away. But investors and bondholders of any of these troubled banks will not be bailed out by the federal government.
Sure. Ron, thanks very much. I really appreciate your being here. This is an ongoing story. I know it's just at the very embryonic stage, so lots going to unfold over the course of today. I know that President Biden's going to be addressing people on the state of the banking system. To those viewing, I appreciate Ron making time because he's in the Bahamas and doesn't have the greatest connectivity in the world. As you may have noticed, we're a little bit out of sync, but the content of this was so important. I really wanted to make sure that we got Ron's input. So Ron, thanks very much for taking time.
Thanks, Tony.